Good afternoon. This is Sean Golding with Golding and Golding, here to provide a quick informational presentation about Internal Revenue Code Section 6751, some strategies that are out there that some attorneys are trying to sell clients, and what to be aware of, okay? Form 3520s are difficult penalties in general for a taxpayer to accept, right? In the most common situation, a taxpayer is a U.S. person. They received a gift from a foreign person. That foreign person is usually a relative. A U.S. person might have graduated from graduate school. They don't qualify for a mortgage. They have no credit. They have family members overseas, parents, grandparents, aunts, uncles that have some money. They want to help the taxpayer out in the United States, so they give them a gift, right? Taxpayer does some initial research and learns that, hey, you know what? Gifts aren't taxable, so they don't think anything of it. Maybe a couple years later down the line, they get another penalty. Maybe they're advanced in their career. They're using a CPA or a tax professional who is telling them they have to report this current gift. Maybe they get another gift down the line, right? They had their first kid or something good like that, right? And now they remember that they didn't file the Form 3520 in prior years. They don't know what to do. The CPA kind of files a prior 3520, doesn't show reasonable cause with that letter, and next thing you know, a taxpayer gets dinged with a penalty. That penalty, especially if it's more than 5 months down the line, is going to be 25%. It's 5% of the gift amount up to 25%, so 5% per month. So once the 5 months have passed, oftentimes it's months, if not years, before the taxpayer learns about the reporting. Then they get dinged with the maximum penalty, which 25%. If it's an $800,000 gift, maybe to purchase a home, then that's a $200,000 penalty, which is absolutely ludicrous and absurd considering that there's no unreported income. There's people out there committing tax fraud. Poor Jane received a gift from her grandparents or an inheritance, and now the IRS wants to take 25% away from that, even though there's no unreported income. The Form 3520 penalty normally comes by way of a CP15 notice, and that CP15 notice gives the taxpayer 30 days to respond and show reasonable cause and not willful neglect. Almost always, it will benefit the taxpayer to submit that reasonable cause statement and set up the case going forward to show that they had a reasonable cause, okay? There's some attorneys out there that are trying to sell a different strategy, which is that the taxpayer should let the time pass, okay, and then just litigate the matter and try to show that under 6751 that the penalty was improper because there wasn't written approval by the immediate supervisor, okay? But there's two very important things to keep in mind with this strategy. The first one is that most Form 3520 penalties are going to, the Form 3520 penalty on the CP15 notice is going to meet the requirements of 6751A. And in fact, under B2, it's going to meet one of the exceptions. Why? Because many times the 3520 penalty is automatically calculated through electronic means, right? It's not that complicated of a penalty. They figure out the number of months it was filed late. Once it exceeds 5 months, it gets hit. 25% penalty. It identifies the code section for a large foreign gift as 6039F, and it was electronic. So guess what? That requirement of immediate supervisor approval in writing is not necessary. But more importantly, or in addition, another key fact is they don't tell the taxpayer the cost, right? Typically, going the reasonable cause route, working your way through the IRS is going to be cost effective, right? If you just let that time expire and you just go and litigate, it's going to be infinitely more expensive to pay an attorney hourly fees to litigate it in court, when oftentimes it can be handled at the IRS level, especially if it's a gift from relatives, it's the first time, things of that nature. If you are considering hiring an attorney and some attorney is telling you to just let the time expire, don't do the reasonable. The idea is this. So, you have to make a request in order to figure out about 6751. Normally it's a FOIA request, Freedom of Information Act, but it's going to take more than 30 days to get that information back, presumably. And so 30 days will pass from the notice on the CP15. And now you're stuck in litigation. You're stuck paying exorbitant fees. So if you're going to go that route, make sure that the attorney is explaining to you what those fees are going to be, what the chances of success are versus just going the reasonable cause route and showing the IRS that it wasn't willful neglect, so that you're making an informed decision. We've had taxpayers reach out to us lately and they feel like they didn't get a chance to make an informed decision, and now they end up, to spend $80,000 to litigate a $50,000 penalty doesn't do anything except feed the attorney's ego, right? You don't need that. So be sure that you have all your ducks in a row before you make that kind of decision where you're going to let the 30 days pass. We have lots of free information available on our own websites. You can always reach out and schedule a reduced fee initial consultation if you think it's appropriate. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.